Good morning and welcome to the TOPPS PLC Interim Results Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and they can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I would like to submit the following poll. And I would now like to hand you over to CEO Rob Parker. Good morning to you.
Thank you. Yes, good morning, everyone. Very warm welcome to the half-year results investor update and presentation. I'm Rob Parker, the Chief Executive, and with me this morning is our CFO, Stephen Hopson. Slightly different update for investors this week. Actually, we're going to cover the usual half-year results, but we've also launched an exciting new goal for the business and a strategy to support that goal, and we're going to spend more of our time through the presentation focusing on that side of the update. So the structure for this morning, I'll do the introduction. Stephen will then cover the financials over the first half, and then I'll come on to talk again about goal and strategy. On then to the first slide of the presentation, the highlights slide. The macro absolutely continues to remain tough. It has been for at least 6 months within our market. Group sales over the first half of the year were actually down 5.8%. We do consider that an outperformance of the market. Fixed data is quite difficult to obtain, but in terms of our analysis and our understanding of the market, we think our market for the tile sector in the UK is down somewhere between 10 and 15% over the first half. So that even at that level, this continues to be an outperformance. And then over a longer period of time, we now believe, certainly by the end of this year, the market for tiles in the UK will probably be about 20% lower than it was in 2019, obviously before the pandemic. And over that same period of time, we estimate our sales will have grown by around 11%. So the business has been consistently outperforming the market and taking share for some period of time. And I'll come back to that theme in one of the later slides. Gross margin over the first half has been positive, has been in growth as we indicated it would be. Stephen will pick that up in a bit more detail. Costs also continue to be well managed. Costs are actually slightly lower, half on half, year on year. Again, Stephen will pick up the detail of that. But the weight of pressure that we see at the top of the income statement of the P&L, that sales shortfall I've already mentioned, does mean that profit over the first half is down on an adjusted basis by around £1.3 million. Online pure play continues to perform very well for the business. That's a new area of the business we established around 2 years ago, and we're seeing very strong growth for online pure play in the region of 40%. We'll talk to that in more detail. And our Parkside, our commercial business, we did some restructuring work there last summer. Having been through a period of sustained losses, we've actually turned that business into a small profit over the first half of the year, going from around £500,000 loss in the first half last year to actually £200,000 gain over the first half of this year. And then our Pro Tiler business, which we acquired 60% of 2 years ago, we're now at the end of the earn-out period on Pro Tiler. Stephen will pick up the calculations in a bit more detail, but we've bought that business over a 2-year period for around 5 times EBITDA multiple, which for a high growth online pure play business, which is performing very well and continues to, we think that's been an excellent addition for the group and has created significant value for shareholders. And then final point on the left-hand side of the slide, the interim dividend has been maintained at 1.2 pence per share over the first half as well. So then moving to the right-hand side of the slide, we're excited to announce a new goal for the business. Our last goal, which was 1 in 5 by 2025, that was to gain a 20% market share of the entire UK tile market. We delivered, we actually exceeded on that with about a 22% market share, and we hit that last November when we announced our full year results. We said we wanted to come back to investors this time with a new goal for the business, and that's exactly what we've done. So Mission 365 is the new goal for the business. That's about delivering £365 million worth of sales, roughly £110 million more sales than we're doing today, or circa a 50% increase from where we are. And we want to get that also with a really strong profit underpin. We realise the profit's very important from a company and shareholder perspective. So we believe every part of our business can operate within a net margin range, adjusted pre-tax profit margin between 8 and 10%. So £365 million worth of sales is our goal, and we want to do that with an 8 to 10% margin, which we think is absolutely achievable. This goal is the goal, and the strategy to deliver it is very much driven by self-help. This is not a market recovery based goal. We think we can get there with very little help from the market, and we'll come on to those numbers. And it's also facilitated by expanding our addressable market. We see the business as a hard surface coverings operation, and again I'll talk to that when we come on to later slides. And there are some investments required in the business. These will be things such as digital marketing, systems, physical infrastructure. Stephen will pick up some of that detail as we go through. So I'll hand you over to Stephen now to cover the financial highlights, and then I'll come back on strategy and goal. Thank you.
Thank you, Rob, and good morning, everyone. So yeah, as Rob says, I'll walk through the numbers for the first half of the year. I'll start with sales. So as Rob said, overall our group sales were down 5.8% to 122.8 million against what was a record first half for the year last year, actually. And as Rob says, we think that is a sort of a market-beating outperformance. We think the market is down year on year between 10 and 15%. And so against that, we think we'll continue to take market share. The group has three kind of parts to it. TOPPS Tiles is the largest part, and then we have Parkside, which is our commercial business, and then Online Pure Play on the right. So this chart bridges the sales into those three elements. Starting with TOPPS Tiles. So TOPPS Tiles like-for-like sales, that means equivalent stores that were trading last year, were 9.2% lower in H1. And that was driven really by lower footfall. So actually the conversion of customers into sales when they came in was actually slightly higher year on year. So footfall was probably the biggest factor on those like-for-like sales. The other really important dynamic to note is that we sell about 60% of our sales in TOPPS Tiles go to trade customers, and then 40% are direct to the homeowner. And the trade customer has remained much more resilient than the homeowner, which is a feature that's happened over the last few years, actually. So that's important to pull out. Within Parkside, within the commercial market, the commercial new build market does remain subdued, and Parkside sales were £0.4 million lower at £4.2 million in the first half. And then, as Rob just mentioned, our online pure play business has continued to see really, really strong growth, up 39% year on year to just under £14 million of sales. There are two parts to online pure play. Pro Tiler Tools is the largest part of it, and that has seen the biggest share of growth. It's continued to take lots and lots of market share, and also it benefits from being a very trade-focused brand, which is therefore the same dynamic as I mentioned when talking about TOPPS. But the other part of that bit of the company is Tile Warehouse, which has also had a really strong first half, with sales at the end of the first half running about 3 times the levels that it was achieving at the start of the year. Moving on to talk about gross margin next. So we saw year-on-year gross margins increase at a group level by 1.1 percentage points to 53.9%. That's also a bit higher than the second half of last year, when margin was 53.3%. And essentially, the margin story kind of played out exactly as we expected it to. Last year, we had seen the trading margin in TOPPS Tiles increase sequentially throughout the year, and stepped up by the end of the year to good levels in Q4. And I think we said at the time that we expected that to be maintained, which is sort of broadly what happened. So therefore, that came through as a year-on-year gain. In the graph, that's reflected as a gain within pricing and COGS, and essentially that's to do with the normalisation of things like shipping costs and costs of goods compared to where they were a year or so ago. The next thing is that, as I've mentioned so far, we've had a bit of a mix change, so more sales to trade customers, which we're really pleased about, but it does come at a slightly lower gross margin, so that's had a slightly dilutive effect, which is the mix changes bar there. The new business growth bar refers to the same dynamic that we've seen actually for the last couple of years, which is that we've seen excellent growth in the online pure play part of the business, and that trades at a slightly lower gross margin than TOPPS Tiles. So as that business grows, it has a mix effect and therefore dilutes gross margin slightly. And then the final bar, FX and other, we had a slight hit from foreign exchange accounting in 2023, and that's slightly less bad this year, so a slight gain from that to take the group margin to 53.9%. Moving on to costs and interest. This slide combines operating costs and interest together. The reason is that these days, with the way accounting works, there's quite a lot of crossover in that, and interest carries quite a lot of the costs relating to leases. So I've combined the two into one chart. And the good news here is that overall costs and interest were down £1.2 million compared to H1 last year. And that's despite some quite significant inflation that we're still seeing in the business of £2.2 million in the first half. That's equivalent to about a 3.5% inflationary increase. And that includes things like pay rises to our teams, some property cost increases, and offsetting that, we are seeing some small savings in utilities. So that's a net cost inflation number in the first half. The biggest sort of reduction in cost, half on half, is in the profit share line. And that refers to variable remuneration in the business, so things like store commission payments that we make and bonuses. It's a natural hedge really that we have in the company to slightly weaker trading, and that's come through as a saving of £2.9 million against last year. There's then some further self-help, so another £1.5 million of cost savings that we've flagged. About half of that relates to a restructure that we made to the commercial business, our part-side business, in the second half of last year, where we took some cost out. And the other half relates to other savings across the stores and supply chain within the company. Online pure play, we've already said a couple of times that it's been growing very fast, and we continue to invest in costs there. So there's an extra £500,000 of costs in that area of the business. And then other costs include things like extra marketing and things like dilapidations and provisions relating to strip outs of stores. So that's the cost bridge. And therefore, I suppose bringing it together into the overall income statement, as we mentioned already, sales were down 5.8% to £122.8 million. And therefore, despite the fact that gross margins improved by 1.1 percentage points and costs reduced by £1.2 million across operating costs and interest, we did see profit decline £1.3 million to £3.1 million on an adjusted basis in the first half. Earnings per share is down slightly more than the profit before tax because our effective interest rate was a bit higher than H1 last year. And I suppose the final thing to say is that we've chosen to maintain our interim dividend at 1.2 pence per share. That's flat year on year, and it's been set in line with our capital allocation policy at 1/3 of the full year dividend of last year. So that's the way that's been done. Moving on to cash. So the group has a strong balance sheet, it retains a strong balance sheet, and we finished the first half at £19.3 million of cash with no debt. That number is pretty similar actually to what it was a year ago. So 12 months ago, we had cash of £19.9 million, so pretty flat. But over the first 6 months of the year, which is what this chart covers, we did see a decline of £4.1 million of cash. Now, obviously, that is impacted slightly by the sort of the natural annual cash cycle. So, for example, in the first half of the year, we paid a final dividend relating to the previous financial year, which is the £4.7 million you can see on the right-hand side of the chart. So we probably think that year on year is the most useful comparison, but there was a decline in the first half. And just talking through the moving parts, we had operational cash inflows of £5.9 million. That was 1.3 lower than the equivalent number from the first half last year, which is in line with the movement in adjusted profit before tax that I just spoke about, which would sort of make sense because a lot of the adjusting items were non-cash in the period, so that sort of follows. Working capital was an outflow of £1.7 million over the first half. That compares with an inflow in the first 6 months of last year, and that is based on payables being lower than they were at the end of the FY23 financial year, as well as slightly higher levels of receivables at year end. CapEx was relatively modest at £1.9 million, although we're still guiding to full year CapEx of between £6 to £8 million, which is the same as we said 6 months ago. And interest and tax payments were similar to the previous year. I've mentioned the dividend payment relating to the final dividend payment for FY23. And so therefore we finished the half at £19.3 million of cash. We have a banking facility of £30 million, which is unused. And therefore, if you add those together, our headroom of cash against those banking facilities is £49.3 million. That banking facility goes on until at least October 2026, with the option of 1 further year extension. I'm just going to touch on the Pro Tiler acquisition. As Rob said at the start, we've reached the end of the 2-year earn-out period now. That ran to the end of the first half. And so I just would like to take the opportunity just to walk through the numbers on the deal as a whole. So as investors might remember, we bought 60% of the shares 2 years ago for £5.3 million. And we agreed a formula at that time to acquire the remaining 40% of the shares that was based on a multiple of earnings that the business generated over the subsequent 2 years. And as the graph on the right-hand side of the page shows, that performance has been very strong. The business, Pro Tiler, has moved from trading at about £250,000 a week at the start of the period when we bought it, and now is trading at about £500,000 a week. So it's broadly doubled in that 2-year period. And so we'll end up, based on that formula I described, we'll end up buying the remaining 40% of the shares for £8.7 million, taking the total acquisition cost to £14 million. However, in the 2-year period that we've been involved in the business, it has been successful and it's generated £2.8 million of post-tax earnings in that time frame. Now, TOPPS has been the 60% shareholder over those 2 years, as I've explained, And so therefore we have sort of taken our share of £1.7 million of the post-tax earnings that the group has made. And so if you take the £14 million that we paid for the shares, less the £1.7 million that we've received as a 60% shareholder in that time, the sort of the total all-in cost for the group end to end has been £12.3 million. ProTiler is generating £2.4 million of EBITDA at the moment. And so if you divide one by the other, we have paid 5.1 times EBITDA for that business, which I would agree with Rob, I think is pretty good for a fast growing online pure play business that is already actually making operating margins in line with our target threshold. So that's a summary of the ProTiler deal. And then my final slide before passing back to Rob to talk about strategy is on the sort of current trading and the outlook. And I suppose what we're seeing is we're seeing quite a lot of positivity really in macroeconomic lead indicators. So GDP is rising, real wages have been rising for 10 or 11 months in a row now. Inflation is falling, as we saw. Mortgage approvals are up quite strongly, and then customer confidence is continuing to rise. But truthfully, these lead indicators are yet to flow through to our numbers. Logic says they will at some point, but they haven't done so far. And the first 7 weeks of trading in the second half have seen group sales down 7.3% year on year, with TOPPS Tiles like-for-like sales down 10.1% year on year. Now, the business does have a lot of competitive advantages, which I think is the thing that's leading to our gains in market share. And we have world-class brands, we have world-class customer service, specialist expertise, and we've got great global sourcing from around the world. And I suppose our belief is that those competitive advantages, combined with the strategy that Rob is just about to talk about, will lead to us delivering strong numbers in the medium term. So with that, I'll pass back to Rob to talk you through strategy.
Thank you very much, Stephen. Excuse me. So yes, moving on to the next slide, we'll talk about a little bit more of a focus on the market, a sort of 5-year view of the market and our performance over that time and our share. The market has been quite variable over the last 5 years. So in obviously 2020, we had COVID impacts, the market was therefore down, and then that was sort of followed by 2 years of what we've referred loosely to as the sort of home improvement boom. Last year, as a matter of record, and this is Mintel data, the market was lower, about 7% down. And as I've already said, we think it will be down again this year. We're confident it will be. And then with the exception of 2020, the key output from this slide really, the business has consistently grown share over that time. And we believe we can continue to outperform the market. And that then combined with a materially enlarged addressable market, which I'm already mentioned, and I'll come on to a more detail on the next slide, actually we think creates a really exciting opportunity for the business. So on to the next slide. Thank you, Stephen. The goal in the addressable market, the goal I covered earlier on, but again to reiterate, £365 million of the sales in a single year, underpinned by an 8 to 10% adjusted pre-tax profit margin. That is very clearly our goal. We believe we can get there over the medium term. And then the addressable market on the right-hand side of the page. So historically, we refer to our market as about £1.2 billion addressable. That was sort of tiles and associated products, what we call essential items, adhesives, grout, trims, tools, these sorts of products. And what we've done actually now is to look at the broader market and really redefine the business as a provider of hard floor and wall surface covering. So if it's within that broader catchment, we think that is now our addressable market. And when you review the sizes of those adjacent categories, we believe that now takes us to approximately a 2.1 billion addressable market. So a 75% increase by redefining the business again as a hard floor and wall surface covering enterprise. And then some of these we've already been operating in, and I'll talk to those in a few slides' time. What that effectively does, though, is, as I say, significantly extends the addressable market for the company. And this slide actually illustrates that point very well. So historically, we may have thought of the business as really being concerned with the kitchen and bathroom area of the home. There's actually much more of the home which is addressable to us. So examples of that might include now kitchen diners running into outdoor spaces where porcelain tiles, 2 centimetre thick porcelain tiles make a great choice, and we can do a sort of an in and out seamless look, and that tends to be a larger number of square metres sold on those sorts of sales. Luxury vinyl tile we started selling a couple of years ago actually makes a great choice for things like entrance hallways or bathroom floors. Wood flooring make great choices for things like lounges or bedrooms. Shower panels, increasingly customers will ask about to place in the shower itself. And then tiles elsewhere in the bathroom. Lots of different areas of the home where we can place hard surface covering products, and that makes the broader addressable market really exciting for us. Onto the strategy on the next slide. Thank you. The strategy from previous followers has been lightly enhanced, I would say. With the strategy, I think, continues to serve the business very well. So we've now clustered all of the existing businesses under one banner of organic growth. We are calling out more clearly new growth channels for the business, so we're signalling very clearly to investors that we are interested in continuing to grow the scale of our operations. Some of those I'll talk a little bit about today. Some of those we'll talk about more over time. And then the two key, what we sort of call horizontals of the business, things that really underpin everything we do in the organisation. Leading product, I think self-evident by the fact we are a specialist. You know, tiles and those adjacent categories are our absolute core specialism. Anything that's in the hard floor and wall covering space, we're not a generalist, so it's very, very important to us that we continue to maintain and enhance those specialist credentials. And then leading people is really about underpinning our world-class service, which we absolutely deliver and aspire to continue delivering across all of our trading operations, regardless of whether they're online or in store, or direct to customers through the B2B channels. We absolutely aspire to deliver world-class service. Environmental leadership, very important to the business as well. It's becoming increasingly important in our sector, and we believe we absolutely can lead our market in that space and are doing so. And then the other enhancement we've made this time out is to include strategic enablers on there, and that is really to underpin the fact that though we are recognising there are some investments we need to make in the business, and Stephen will pick those up in a bit of detail today. We're very confident we've got the team to deliver this plan, and this is the senior team that runs the business day to day. So myself, I've been with the business just coming up for 17, or just about 17 years actually, and I've been in my role as Chief Exec since 2019. Stephen's been with the business coming up for 4 years. He's an experienced CFO, now very well established in role. Our group buying director, Tim Tatlock, has been in the tile and associated product sectors for in excess of 20 years and been with our business almost 20 years. Very well known across the industry, knows excellent knowledge, technical knowledge, and knows the supply base very, very well indeed. And then Simon Robinson actually joined us back in January, so a relatively new member of the team. Simon's joined us as Sales and Operations Director for TOPPS Tiles, so really running the TOPPS Tiles business day to day. And again, Simon brings with him an excellent background and credentials, most previously working as the Operations Director for the Toolstation business in the UK. We currently have an interim HRD in role. We are recruiting for a permanent HRD, but again, Joanne Shawcroft comes to us with excellent credentials, is doing a great job in the interim role, previously HR Director or CPO, Chief People Officer at the DFS business in the UK. And then ProTile, we've mentioned a couple of times, the two co-founders there have been key to the growth of the business up to this point, including the last 2 years, Sam and Todd Bucknell, and really delighted to say they absolutely desire to continue their journey with the group post the buyout of their equity. And we think that's a really exciting journey to continue partnering with them on as well. So on to the next slide then. Lots of things going on in the strategy to deliver this goal. 5 things that I'm really going to pull out and focus on today as part of this presentation. And the idea is we'll talk about more things over time because there's a very broad range of activity going on. But 5 things I think are really key for investors to understand, and we'll be keen to continue updating investors on our progress in these spaces as well. So those 5 things are trader digital experience. We think there's more to do. That's my next slide. The category extensions I've already spoke about, how we're actually going to deploy and activate those opportunities. B2B growth we've been talking about for a while. We think that's a bigger opportunity from here. The ProTiler business, already mentioned a couple of times, we've got very good ambition, strong ambitions to continue growing that business. And Tile Warehouse is the newest part of the operation actually, which I'll come on to in a few slides' time. So trader digital experience, I think it's important to remind investors that actually the trade side of the business, particularly in TOPPS Tiles, has been the strongest performing area of the business. We've consistently grown trade. We've consistently outperformed the market. It's now more than 60% of our sales across TOPPS Tiles are to professional installers. And that really has been built around significant strength in terms of our store base, which drives convenience for trade, over 300 locations across the UK. It's our in-stock availability, which is excellent on all the sort of trade essential items that those customers really need, the adhesives, the grouts, etc., those kind of products. And then the relationships we have between our local store teams and their local trade base, which drive lots and lots of loyalty and share of wallet. I think we're also recognising that there is a bigger opportunity in the trader digital space, and we're now really keen to push into that as we move forward. And we think there are some important steps for us to take. So on the right-hand side of the slide, it really recognises what some of those steps might be. So we already have a trade website, but we think there's now a good opportunity to refresh that website to enhance it. And one of the things we've spoken about with investors this week is that there are some elements of friction in the trade digital journey. So an example being when you come to register as a trader, you can do your initial registration on the website. You're then required to come into store to sort of have your registration validated. And there are a number of steps you have to go through before you can actually access the full trade offer, including trade pricing, etc. We want to make that part of the journey much simpler. So we plan to relaunch the trade website, review the trade registration process, make it easier for traders to access the excellent value that we think we really have to offer them across the business. Trade pricing then links into stores as well. We are experimenting with showing more trade prices in stores. Historically, we've priced everything at the retail price, and then we'd have to engage traders around what the correct trade price would be for them. So we're starting to show more trade prices in the stores and actually having some good success with that as well. We've had a loyalty scheme running for trade for some time, but again, it's time to refresh that. We plan to review it, and we plan to focus harder on sort of features and benefits for trade to really make sure they're locked into our ecosystem. And then the plan is we deliver all that through the app, which I'll come on to last. Trade credit is an interesting area. We've had lots of different solutions over time across the group. About 18 months, we decided to bring trade credit in-house, and actually we feel we've really landed a very good solution, and now we're very confident. It's a small part of what we do currently, but we think there are bigger opportunities to be exploited there, particularly as a group we go after larger trade spenders. We know that credit is very much an expectation of those customers. We feel now we've got a really good solution to offer them. And then a customer engagement platform, or perhaps customer relationship management, as people may have known it historically, is a really important area for the business. We have a CRM system currently. We think that needs to move on. We need better capability, better ability to market to our trade customers and sort of talk to them in real time, and also better opportunities to make more of the extensive amounts of customer data that we have at our disposal. So a really modern, up-to-date customer engagement platform we think is going to be a really important addition. And then the idea is we embed all of that, we wrap all of that up into an app. The purpose of which, of course, is we essentially keep our traders plugged into our business 24/7, so we can talk to them, we can market to them, we can update them on their loyalty and reward points, etc., that they've earned with us. We can enable things like really strong click and collect functionality through an app. We think all of that embedded into that as our ecosystem for trade, digital interactions, will be a really strong step forward for the business. In terms of category extensions then, so the structure of this slide really is the boxes across the top are actually areas where we are already involved in selling products. We started with outdoor tiles a few years ago now, just after COVID. I think we really pushed harder into outdoor tiles. That's been an area of technical innovation in the market. So porcelain, 2 centimetre thick porcelain tiles make a brilliant outdoor tiling solution. We've had some good success there, but we still think there is more to be done. Luxury vinyl tile we've had in the business now for a couple of years. Again, we've now got it rolled in. We started with a trial online, then into some of our stores, and we've now rolled out to all of our stores. Had some good success, but there is more that we can do there, we believe. And then shower panels are currently being trialled in about 100 stores. Again, good signs. We'd like to push on and roll that out across the store estate. And then on the bottom half of the slide, these are areas we're not currently in, certainly the first two, laminate and engineered wood flooring. We don't sell that currently. We're about to launch a trial in some of our stores. Based on pending success, we would then plan to roll that out. And then splashback, similarly, we're about to launch a trial on splashbacks with a view to rolling these things out across the business. All of which great opportunities for us. And then what we call double XL porcelain. These are the very large slabs, as they're sometimes known, very large pieces of porcelain tile which are coming out of factories, which can be 2.4 meters long or 3.6 meters long, very, very large pieces. And they have a range of different applications. Quite limited today in the UK market, but we see that growing over time, and we want to make sure we're playing a really full and active role because this is absolutely in our sweet spot as a tile specialist business. And then on to the next slide to try and tease out what some of those opportunities might look like in from a value perspective, from a sales and profit, or from a sales perspective. And you can see here really we've broken down the market across the UK. The key point being the addressable market of all these categories is about £1 billion. Our share of them is currently very, very small. There's about £11 million worth of sales being captured here out of £1 billion addressable. And for a business that has a very strong core market share, as I've said at the start, about 22% of the entire UK and sort of associated product market currently across the group, We think even a 5% share of these categories would be very modest and should be very achievable. Slightly higher for outdoor because we're already sort of further on with that journey and it's much closer to our core market. But if we achieve the level of market share that we've targeted on this page, that's £50 million worth of sales, and we're currently doing around 10 or 11 today. So that represents a very strong opportunity. And the key then really being, how do we deploy against this activity? How will we activate this? And we think there are 4 things really. One is obviously range, customer offer, either refining and honing and refining what we've got, or introducing an offer to the business, which is what we're currently very active with. The marketing of these products is key as well. Our experience is customers do come to us and ask for them, so there's an expectation that we will sell these products, and we want to make sure we can really deliver on that for our customers, but actually making sure the customers are better educated in terms of an expectation that we'll have these as well. So we think there's a much bigger job to be done in terms of marketing these adjacent categories to our customers and potential customers. Training of colleagues in store, of course, is key. We absolutely pride ourselves on our world-class levels of service. We need to make sure we can deliver that in our core offer of tiles, but in these adjacent categories as well. Our experience so far has been really positive in that colleagues seem very happy selling a broader range of product. They've actually engaged with it very well, but there'll be work to be done there. And then the final one is in-store presentation, where obviously we're keen to make sure we've got very good merchandising and fixturing of stores, and ultimately we want to try some new treatments in a couple of stores as well. And if they're successful, we'd look to roll those out based on an acceptable level of return on investment, obviously. Moving on then to B2B side of the strategy. B2B has been an increasing area of focus for the business for some time. We've had the commercial Parkside operation for a number of years now. We've actually built a TOPPS Tiles contracts team, which is actually now represents more sales than the Parkside business itself. So that's been very successful for us. And in acquiring Pro Tile, obviously, a good majority of the Pro Tile sales are through the B2B side of the market as well. And the way we've laid this page out is essentially all of the customers we can serve, the sort of homeowner, starting on the left-hand side, then through to sort of smaller local tile fitters, which historically has been TOPPS Tiles, sort of really key heartland, into maybe sort of slightly larger operators, local developers, these kind of people, smaller contractors, and then through to the much larger type of customers, large contractors, national accounts, up to and including house builders. And then the other point we've really laid out here is what is the route to get to that customer. There's this sort of idea of inbound, i.e. those customers will come to us. Our core customer, of course, the homeowner does come to us, walks into our stores, comes onto our website. Even the sort of smaller, the larger sort of local fitters will come to us, and we've done a good job with the TOPPS Tiles contracts team of being able to respond to those. But we're still quite reactive in that mode. We wait for them to come to us first, and then we sort of understand how we can really help them with their requirements. Parkside does work on an outbound selling model. We've got a sort of national sales team on the road, in and out of architects and designers' offices, these kind of things. We think there's a bigger opportunity to drive a much greater share of the market by essentially having more of a proactive approach to sales in this space. And that's exactly what we plan to do. And then on the following slide, in terms of how we would wrap that together, so we do see it as a material opportunity, and we think we've got lots and lots of capability across the group to deliver this. So we've got a range of different brands that we can present. So we've got our TOPPS Tiles contracts part of the business. We've got Parkside, we've got Pro Tile. There is all important different players in the market. We've got lots of physical assets to deploy here, so over 300 stores across the UK, which essentially serve as 300 collection points for our larger trade customers. That can really help drive convenience for them. We've got our fleet of own vehicles and very good 3PL arrangements as well to ensure accurate deliveries to sites should that be required. 200,000 square foot of warehousing across the UK and about £35 million worth of stock to deploy. We think that's a really unrivaled offer for some of these larger trade customers, B2B side of the market. And then obviously we have the core range of tiles and associated products, and as we extend our offer, we can offer much more of a wraparound service to some of these customers who, time and time again, what we learn is what they really value is convenience, ease, and simplicity. In conversations we're having with these people, it becomes quite clear there's just a really low level of understanding of what TOPPS as a group can actually deliver. People still think of us too much as a chain of retail stores that homeowners will sort of use. When we actually talk about the broader capability of the group to some of these much larger customers, they're really impressed with what we can do, and we think this is it's a really exciting opportunity for the business. All of that then gets wrapped up through our world-class service credentials. So whether that's our in-store teams, the direct sales channels that we have, the direct selling teams, our central support, and our digital convenience, we think that makes a really compelling offer for these customers. I'll move next then on to ProTiler. We've mentioned it a couple of times. ProTiler is a market leader in their space, tiling consumables. It's been a really strong engine of growth for the last 2 years. Stephen's already mentioned it, but we've essentially doubled sales from when we bought the business early on in 2022. It's been an excellent journey. There are a number of different parts of the business, but ProTiler Tools is the biggest part of the operation. And we continue to be very excited about what we can do here. In essence, we are saying with this page, we've doubled the business from when we first got involved, and we believe it can double again. So going from roughly 25 million today to about 50 million pounds, they've been taking share very rapidly in the market, and we think that journey can absolutely continue. So it's a really exciting part of the overall strategy and part of the delivery of the goal for the business. We do need to see a little bit of investment in the business. So from a logistics warehousing perspective, as I say, the business has doubled from when we bought it. We are now starting to feel a little bit constrained in terms of warehouse space, and we do plan to make some changes and some additions to the operation over the latter part of 2024. And then Tile Warehouse is the newest part of our operations. We started this business from scratch back in 2022. This represents a £100 million market for tiles in the UK. So the market for online pure play tiles, we estimate, is at least £100 million. There's a really clear opportunity here for a more value orientated part of the offer. And Tile Warehouse allows us to compete in that side of the market without actually taking the TOPPS tiles brand and core customer too far away from the traditional heartland, which TOPPS tiles does tend to slightly over-index in a slightly more affluent customer base, and that's quite an important part of the model. So Tile Warehouse allows us to compete on a value basis much more cleanly and away from the core brand. And I'm really pleased to say we've made great progress over the first half. So we've roughly trebled the run rate of sales from the start of this financial year through to the half year. So in 6 months, we've roughly trebled the level of run rate sales in Tile Warehouse, which is great. And I continue to be very excited about the opportunity, which we've said previously and continue to. We think this is a £15 million sales opportunity, and we think we can get there within 5 years. So that concludes the run through the sort of key points of the strategy. I'll hand you back to Stephen, who'll talk through some of the financial highlights.
Thank you, Rob. So yes, this chart illustrates Mission 365 from a sales perspective. It gives, as I say, an illustrative, indicative impact of how that might come to pass. And I'll just walk you through it. So it starts with the sort of approximate market consensus for FY24 sales for the group, which are about 250 million. The first bar refers to the changing market that we're embedding into these numbers over the medium term, and you can see that I'm assuming 10 to 20 million pounds of support from market growth in volumes and also business as usual pricing, so just generally inflationary price rises. 10 to 20 million pounds compared to 250 equates to about 4 to 8% increase from that. We haven't got a time frame on the goal, so it's a medium-term goal. But if you took that as an example to be over about 4 years, then 4 to 8% becomes 1 to 2% per year for 4 years. So that's the sort of level of market assumption that we're assuming. As a reminder, we think the market today is about 20% lower than it was in the pre-pandemic levels. And so therefore, I think the conclusion from that is that we're not relying on the market recovering back to where it was pre-pandemic for these numbers to be delivered. And then the 5 bars on the right-hand side of the chart refer to the 5 strategic growth areas that Rob just spoke to. And so the first one was all the digital trade stuff that we talked about. We think that could be 15 to 20 million pounds. Now that can be delivered through lots of ways, but things like increasing share of wallet and increasing the number of trade customers we engage with, we think we'll deliver that. That is about a 10 to 15% increase against the current level of trade sales within the TOPPS tiles. So that's that one. The second one, the new categories, that was the slide where we talked about £1 billion of potential market. We've actually slightly de-risked the numbers in there in terms of what we think we'll get at, and so we're sort of putting 25 to 30 million pounds against that new area. B2B growth, so the national accounts, the contractors moving more into B2B, we think we can do 15 to 25 million pounds more from that area. ProTiler, we just spoke to, so it's at about 25 million at the moment. We think we can double that to about 50 million. And then Tile Warehouse is currently still relatively modest levels, the final bar, and we think we can take that to 15 million pounds, which takes you as an indicative way to how we might get to something like 365 million pounds, which is the goal we've spoken about. And to understand what that means for profit, I think it's worth just taking a few seconds to look at our historical cost performance over the last few years. And this chart bridges our operating costs and interest from 2019 to 2023, 2019 being the last sort of clean year pre-COVID. And what the chart says in essence is that over that very inflationary period of time where we've had over £13 million of inflation, it's our cost base, the group has actually offset all of those through savings. And therefore the cost base of the equivalent business, so that's the TOPPS Tiles and Parkside, was actually flat over that 4-year period. The growth in costs on the right-hand side of the chart is shown because we've added a new part to the business, the online pure play part of the business, which has taken costs up by £5 million. But as you know, that's been a sort of good success story for us over time. So as a result of that, the group's costs have been on a downward trend when expressed as a percentage of sales, from about 54% of sales to about 48% of sales over that time frame. The next chart then explains what I think will happen to costs as a percentage of sales as we look forward and move towards the delivery of the Mission 365 goal. And the short story is that I think costs expressed in that way as a percent of sales should fall from the 48% that they were last year to a range of 42 to 44% of sales, which is the bar on the right-hand side of the chart. The bar on the left-hand side of the chart breaks down the cost base of the business into its component parts in 2023. And you can see that just over 60% of the cost base of the group currently relates to the TOPPS Tiles store network of just over 300 shops. And that network is a real strength of the group. And we think it's sort of a good number in terms of the number of shops that we need, but we need to leverage really the shops more. We think we can put more volume through the stores, and we think we can do that with relatively little additional cost because things like rent and rate are obviously fixed. They don't change as we push more through the stores. And in fact, that's true of quite a lot of the cost base of the business. It doesn't tend to flex that much with volume, so it is relatively fixed. That means as we push more sales through, then the cost base shrinks as a percentage of sales. We do need to make some investments to enable this growth story, and they're detailed on the right-hand side of the chart. The first one is into systems. We've talked about things like a trade app today and a customer engagement platform, that's CEP. We also need to make investments into the core systems of the group, so our warehouse systems and our central finance systems and so on. And we think that will spend just slightly less than £3 million over a 3-year systems investment program on that. The second thing is that we want to spend more on marketing. We think we can sell the message of the business quite a lot more than we're currently doing. And you can see if you look at the break-up of the cost base, the yellow marketing bar actually grows in size between 2023 and the future cost base of the business. So we want to push more into marketing. We will need to recruit into some specialist roles, such as digital marketing maybe, or growing that B2B side of the business, a few specific areas. And then, as Rob said, we need to invest in supply chain, Pro Tiler tool supply chain in the more short term, and then at some point we will need to add additional facilities to our group and TOPPS Tiles supply chain as well. But most of the costs will increase more slowly than sales, and as I've shown on the last slide, we've been quite good at maintaining quite tight cost discipline over recent years, and so therefore I do think costs as a percentage of sales will fall over time. And so therefore the sort of the financial outcomes of Mission 365 are then shown on this chart. We've talked about sales quite a bit, so £115 million of extra sales from about where we'll finish this year takes us to 365. I think gross margins will fall by 2 to 3 percentage points versus today for the reasons written on the chart, largely to do with business and category mix changes over time. But because the cost base of the business expressed as a percentage of sales falls in line with the chart that I just showed, I think that we can increase our adjusted profit before tax margins to between 8 and 10%. And therefore, if you take £365 million of sales and sort of do the maths, multiply that down, you get to a profit before tax number of at least £30 million, which is our target. Other types of investments needed on the bottom line, there'll be some working capital investment required. And as we've mentioned a couple of times, we will need to invest in supply chain. And we've signalled up to it's an approximate number, but perhaps £5 million of capital expenditure over the medium term to support that. But even taking that into account, this plan should deliver more substantial incremental returns on capital than currently, and should really move forward in that way. So that's the financial outcomes of our Mission 365 plan. I'll hand back to Rob to summarise.
Thank you, Stephen. Yeah, excellent. So in summary, we think Mission 365 is an exciting new goal for the business. It is combined by a really clear financial target, which is 8 to 10% adjusted pre-tax margin for the business, which will drive a significant shift in profitability from where we are today. We've significantly expanded our addressable market. We're very thoughtful about how we can participate across a broader range of hard floor and wall surface coverings, and I think that offers us an excellent opportunity for growth. And then the 5 key initiatives, which there's lots of things going on in strategy, to repeat myself, but 5 key things we've spoken about today, and we want to keep, we will continue to update shareholders on as we go through the period of time. So that really concludes the formal side of the presentation. There's a chance to move to some questions.
Perfect. Rob, Stephen, thank you very much indeed for your presentation. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the top right corner of your screen. While the company take a few moments to review those questions submitted today, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. And Rob, Stephen, as you can see, we have received several questions throughout today's presentation. And if I may now hand back to you and kindly ask you to read out the questions, give responses where appropriate to do so, and I'll pick up from you both at the end.
Thank you very much for that. What we'll do is I'll sort of farm out the questions to either myself or Rob to answer, and then we'll get through as many as we can in the time that we've got. So thank you for your questions, first of all. And I think we'll probably go through them in the order that they're in front of me. So the first question is from John, and it says the trading estate increased slightly to 304 stores. What are the future plans for store expansion or optimization? So I think, Rob, I'll maybe start on this and then hand to you if you've got anything to add on. So first of all, yes, John, and thanks for your question. You're absolutely right. The store estate increased by 1 in the first half. We had the 1 new store opening up in Newcastle, and we also did 1 relocation as well, which is a sort of one in, 1 out. I think the first thing I'd say is actually the store estate has been on quite a journey over recent years. So we peaked at just over 370 stores, actually. So that's come down about 20% in recent years. And that has been quite a successful program with sort of closed stores where we maybe had 3 stores in a town going to 2 or 2 going to 1. And we've managed to move sales across to the remaining store and hence increase profitability as a result of that. And that's been a sort of good journey for us. I think the estate we've got now at just over 300 is actually a really good estate. I mean, it's an estate that no one can match in our competitor set. And we see it as a really good strategic asset for the group. Clearly, it is, as I showed on my cost slide, it is a very material part of the cost base of the group, and therefore, as you'd expect, we will continue to review that over time. Our key point, I suppose, when it comes to stores is that we think we can actually push a lot more through them. We think we can increase sales densities and therefore increase the profitability of those stores as we continue to grow the top line of the business. But yeah, that's my sort of general take. Rob, do you have anything to?
No, I think the last point's the key one, which I think that is worth clarifying. And a lot when we talk about certainly the category extensions and the additional sales, we see a lot of that being driven through the existing Top Styles estate, which obviously from a return on investment, return on capital perspective makes it super attractive, because that's where we really maximise the operational gearing, which is in Stephen's slides pretty clearly, but is where we really start to drive the operational gearing and the drop through into net margins.
Thank you for that question. The next question is also connected with property, and it says, how does the average unexpired lease term of 3 years provide flexibility, and what are the plans for stores with shorter lease terms? So the question here is picking up some disclosure that we give in the RNS statement, where we talk about this sort of time to the next lease break or end of lease time period. And the way we think about this is we segment our Top Style store estate into 3 chunks, really. And so the sort of the top chunk of it is our most strategically important stores, those that are most profitable for us. And when we're thinking about those from a property perspective, we're thinking about maximum security. So how do we lock into those stores for a period of time such that we can guarantee that we'll be able to keep trading from them and keep generating value for the group. At the other end of the scale, there's stores where we want maximum flexibility. So maybe we think we're in the right town, but maybe we're not quite in the right pitch, or the rent's not quite set at the right level, whatever it might be. In those stores, we will try and get maximum flexibility, so we can have the option to do things in the future. And then in the middle, I suppose, we try and strike a balance between those two. And so when we're thinking about new leases, we will very often maybe sign up for, say, a 10-year lease, but we'll ask for a 5-year break in it, which therefore means that we have the option to move things around. And we have done that very successfully in recent years. That's been a big driver of our success in terms of exiting those 20% or so of stores that I spoke about in the answer to the last question. So I think flexibility is really important to us. And I think, to be honest, I do think that, you know, having 3 years on average till the next break or end of lease does give us that flexibility. Anything to add on that?
I think it's a good summary. Yeah, no, nothing to add.
All right, thank you. Well, thank you for that question. The next question concerns the addressable market. Rob, I think you may have answered part of this, but the question says, the addressable market has been expanded to include hard floor and wall surface coverings and related products. What are the implications of this broader market focus for the company's growth strategy?
Yeah, I mean, I think we have covered it really in a fair bit of detail today. I think combined with the point of we believe a lot of it can be delivered through our existing business channels. Therefore, you know, the operational gearing makes it very efficient. Customers see us as a hard surface covering business. They come in and ask, you know, where's your LVT in store? Do you sell LVT? These sorts of questions. So I think there is lots of evidence there is an expectation and a demand from customers that I want to make sure we can really service those demands, those expectations. Colleagues seem really happy serving a broader range of categories. I think it's a great opportunity. We've done a bit, we've had success. There's more to go after here. So yeah, it's one of the opportunities we're really excited by.
Thanks, Rob. And then the next question is about new goal. So the new goal is to increase sales to 365 million and to achieve an adjusted profit before tax margin of 8 to 10%. That's a good summary of the new goal. So that's good. What are the key drivers and assumptions behind this goal? Well, I mean, I guess maybe if I briefly start, I mean, hopefully we've chatted you through them within the presentation today. And thank you for the question. I mean, we see quite a clear series of 5 key initiatives that will deliver 365 million. Importantly, the 365 is not reliant on a massive market recovery. Obviously, it would be great if we see that, but we don't need that to happen to get to the 365 million. And then in terms of the profit before tax margin, we are very conscious that, you know, we need to deliver increased profits. The goal refers to that in the title of it. It's grow sales and build profit. It's sort of right there in the statement of the goal. And so we think we can do that. And I've sort of explained how we think we can leverage the cost base of the business while making some investments in certain areas and still deliver, that 8 to 10% net margin. So, I mean, hopefully we have laid out the key drivers and assumptions, but anything?
I'll make a couple of points. I think firstly, ProTiler currently has a 10% net margin. ProTiler is a very different model, doesn't have all the costs of stores, etc., and higher labour bills, but it operates off a 30% gross margin and is delivering 10% net. That gives us real confidence. They're already there. And the TOPPS Tiles business historically operated off an 8 to 10% net margin. The key to get back there is operational gearing. We need to push more sales and generate more GP through the stores. That is the thing that will trigger the upside to the TOPPS Tiles part of the business. But we've been there historically. There are no structural reasons why we can't get back there. And historically, I mean, sort of within the last 5 years. It's no longer ago than that. So no structural reasons why we can't get back there. And that's what the strategy is revolving around.
Thank you, Rob. So then another couple of questions that have just come in. The first one is to do with our balance sheet structure. So no problem if you missed this, that's completely fine. So the question is essentially, do you see debt reducing substantially? So actually, Anthony, we don't have any debt in the group. So just in case you did join late, you could flip back to slide 10 in the presentation when you have a moment later on. What that explains is that the level of cash in the business, so we have cash, we don't have any debt in the business. We have £19.3 million of cash at the end of the first half. What we have, which you might be thinking of, is we've got £19.3 million of cash in the bank, and then we also then have a debt facility, so an arrangement with our banks to provide us with borrowing facilities that we can access if we need to use them, of £30 million. So that's a sort of committed facility which is available to us to use if we need to, but we aren't using that at the moment. And so what I explained when talking through slide 10 is that if you take the £19 million of cash that we have in the bank, and then also the £30 million that we could choose to access if we needed to, you add them together and we have over £49 million of headroom to our banking facilities. So no, we have no debt, and therefore we don't see debt reducing substantially because we don't have any. But thank you for the question. And then another question is, do you see driving up return on capital employed and return on equity as important? And again, maybe shall I briefly start, and then you can add to it, Rob. So first of all, yes, I mean absolutely we do. We publish our return on capital employed numbers, and so our lease adjusted return on capital employed in the first half was up slightly. So 16.4% was our ROCE in the first half. That's up from 15.5% in the first half last year. A big driver of that for us, as well as profitability, is the amount of lease liabilities that we have on the balance sheet, which drives that number, which has come down slightly, which has been helpful. Do we see driving up as important? Well, absolutely. And I think a big part of the way that we've tried to discuss our sales and profit growth plans today within Mission 365 is to emphasise the fact that these aren't relying on a very, very large amount of either capital investment or working capital investment over time. I think, and our modelling suggests that you should see pretty substantial improvements to return on capital employed as a result of delivering this plan. So yes, and yes, I think is the answer to the question. Anything to add on that?
No, I don't know how to answer it other than yes, arguably it's the most, return on capital employed arguably is the most important thing. And if I remember my classical finance theory correctly, it's effectively an amalgamation of net margins and asset turn. In our world, we use net margin therefore as a shorthand because this isn't a big balance sheet play, I suppose is the point. If we needed to make multi-million-pound investments, then we'd be talking about that in the same breath, but largely we don't. Therefore, net margin is our shorthand, and that will drive up return on capital employed. But ultimately, that's the thing we're really focused on, I think.
Thank you for that question. I think that's it, actually, in terms of the questions we've got now.
Yes, that's correct, Stephen. I believe you have addressed all the questions for investors today, so thank you for that. And of course, the company can review all questions submitted today, and we will publish those responses on the Investor Meet Company platform. But before redirecting investors to provide you with their feedback, which I know is particularly important to the company, Rob, could I please ask you for a few closing comments?
Well, no, great. It's just, thank you for people's attendance today. We hope you found that useful. It's the third one of these we've done. We're keen to keep reaching out to perhaps some of our smaller investors and broaden the opportunity for people to engage in the story. Hope you found it useful. We're really excited by our new goal, Mission 365, and hopefully we've laid out our strategy as clearly as we can today that we believe will help us get there and be successful with it. So thank you very much.
Thank you.
Fantastic. Rob, Stephen, thank you once again for updating investors today. Could I please ask investors not to close this session, as you will now be automatically redirected to provide your feedback in order that the board can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of TOPPS PLC, I'd like to thank you for attending today's presentation, and good morning to you all.